You're about to get a behind the scenes look of what it's actually like to have a tax plan prepared for your business. I'm Cindy McGee. I'm a CPA and the founder of NextGen Tax. My team and I have the privilege of building tax plans that save our clients money every year. I want to show you a quick example. So in June of last year, we had a new client come to us who had a new business venture that was being really successful, and they were concerned about how much they needed to set aside in taxes. We quickly advised them, let's work together to figure out how little you could set aside in taxes. We're going to start by looking at their financials and then step through how we built a plan based on this data. Now, the basis for any tax plan is financial results. We want to look at your results to date, but we don't want to just stay there. We could clearly see that they were trending well for the first 5 months of the year. But on the second tab, you'll see our first step in building the plan is annualizing that data. We want to see what the full year would look like. The tax return is based on a full year's financials. So we need to project your annual financial results. In building the annualized financials, we first just take an average of the prior months that we already know that have happened so we can use those results as a baseline. We then adjust that for anything that might be a one-time expense or expected changes over the balance of the year. Ultimately, we use that to get your total revenue for the year, estimated total expenses for the year, and finally, your net income. This net income is what you pay taxes on. So this is what we need to consider to build out a tax plan. The next step after analyzing the financials is building what's called a pro forma tax return. Basically a projected tax return that says, based on these financial results, here's what you're going to owe in taxes. So we take this bottom net profit number and put that into the pro forma tax return. You'll see that same number comes over here. And this is a snippet from the tax software to just make this illustration really simple. Based on this, they are taxed as a sole proprietorship. They're going to owe $476,000 in taxes for the year. Nobody likes that number. There were 4 things we did to build a basic tax plan to just confirm that we could save this client money. The first thing we did was we realized they're not being taxed in the appropriate way. Meaning, as a sole proprietorship, you're subjected to self-employment taxes. In their case, almost $58,000 worth. If we convert them to be taxed as an S corporation, still an LLC, but now taxed as an S corporation, we can eliminate that self-employment taxes. So the first thing we did was converted them to be taxed as an S corporation. It's a simple paper filing and allows you to avoid a significant amount of self-employment taxes. That's step 1. Step 2 is we had to optimize the way that they receive income. Now, in the prior year, they were W-2 and they earned about $122,500. They wanted to stay at that level, but paying themselves via W-2 at that level would not be optimal. So on this next page is a snippet of the work paper we created to assess how much would be the optimal amount to pay them in W-2 income and what other methods should we consider as a means to deliver cash flow into their home. In their case, we optimize their income in 2 ways. First, we only gave them the amount of W-2 compensation required. See, there's reasonable compensation requirements that come with being taxed as an S corporation. For this client, theirs was $35,000 per person, so $70,000 total for the household. That was the optimal amount for them to earn via W-2. Now that didn't match the $122,500 that they were accustomed to receiving. So we needed to have another avenue for income. Our second avenue was creating what's called an accountable plan. Now, in short, an accountable plan provides tax-deductible allowances to employees, that's you as the owner, we just made you an employee, in a tax-free way. It's deductible for the business, but tax-free for the employee. Using that split of income, we were able to match what they were accustomed to receiving via W-2, but only requiring 50% of that to be taxed. So tax them as an S corp instead of a sole proprietorship. Put them on payroll so that we meet the requirements. Give them an accountable plan. The fourth and final thing we did for this client is help them take advantage of the Augusta rule. If you're not familiar with that rule, please Google it. It's a very beneficial tax-free way to deliver cash flow into your income, into your household. Doing all of those things gave them this after picture. Instead of paying roughly $476,000 in taxes, they're going to pay $346,000 in taxes, a $130,000 tax savings using these 4 simple strategies. Their fees to us, about $15,000. Net gain, $115,000. This is what it looks like when we prepare a tax